It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank information. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show, and I'll tell you what, I got a lot to cover today, and I've got some exciting news coming up. The contracts haven't been signed, so I can't share I can't share yet, but I'm going to encourage you to stay tuned to this show because I've got some really, really big news coming up in the next few weeks here, so stay tuned. The biggest news, obviously, from the economic standpoint is still inflation. In fact, I've got an article here, for example, in UK, talking about price inflation for food has hit a... Welcome to the Your Personal Bank Show, and I'll tell you what, I got a lot to cover today, and I've got some exciting news coming up. The contracts haven't been signed, so I can't share I can't share yet, but I'm going to encourage you to stay tuned to this show because I've got some really, really big news. Record high in the UK. For example, in the last month or so, hit a new record of 16.7% in January increase on food inflation. And then the next thing is, and part of that is because there's a shortage. British supermarkets, in fact, are now rationing fruits and vegetables because there is a shortage of the of supply because of the high cost of raising food. Okay, so we've been seeing this in the United States also, and some people say, well, that's the UK. Who cares? Here's the thing I think people need to understand. Oftentimes, things that happen in Europe then come to us, maybe not quite as strongly, but they do tend to come this way, partly because Europe has gone down the path of the direction in terms of what I would call socialism, farther down the path than the United States has. So it's a really good measure a lot of times, and is a really good warning, too, at the same time, that if we continue to follow the same path, we're likely to get similar results. So these things are of major concern. Food is not something that is optional, okay? The bottom line is we need food to survive. So when there's food shortages and high inflation on foods, which we have certainly seen in the United States, I mean, look at the price of eggs. That's one of the craziest ones out there. But just about everything. We've seen double-digit inflation over the past year or so, and I've done in previous shows, I've even shared where USDA, our own government, has predicting similar type of increases in 2023. We've seen about, on average, over the last year or so, 2 years, about 20% or so increase in food prices overall for the average household. And they're talking about another roughly 10% increase, depending on what you're talking about. That means food prices in 3 years will probably increase about 30%. And folks, that's not small change. The other part of it is what's probably the most insidious part of inflation is the fact that it often works like a rubber band. In other words, when it stretches out, when you stretch out a rubber band, it's usually, it's kind of stiff and it's the hardest to stretch it out. But if you stretch it out and you keep pulling it open, so to speak, stretching it out, and then you release it, it'll go back, but it won't go back as all the way back to where it was. And that's a lot like how inflation works. It's that elasticity. In other words, these prices have gone up. We obviously at some point in the future may see some pullbacks on those prices, certainly from the highs, much like we've seen this from the highs of gas prices, for example. This last summer, summer of 2022, we saw record high gas prices in the U.S., average $5 a gallon. Prices have gone down from there for a number of reasons, but they're not back down to where they were, say, in 2020. They're about $1 a gallon more than that. So they did go all to all-time highs. They did come back, but they didn't go back to where they were. And that's often, very commonly, how inflation works and prices work. So what that brings me to is I've got some great news. Like I said, we've got some new products that have come out. One of the advantages of this higher interest rate environment, there's a lot of disadvantages that people are very much aware of. high inflation and interest rates are really tough on real estate, borrowing, any kind of borrowing, of course, any kind of debt. The stock market in general doesn't like high interest rates and inflation because it's bad for business. It's hard for businesses to borrow money and expand and et cetera. But whenever you have a loser, you always have a winner, and the winners are getting into the interest rate sensitive assets, things like bonds, things like dividends, in fact, even annuities and stuff. We're seeing some tremendous improvements and increases of those types of assets. And why this is important to understand is, I guess what I'm trying to say is, there is no question the past decade or so was a great decade for investing in real estate or the stock market. Both of those markets had tremendous gains over the past decade or so. And a big part of that reason, I don't think any rational person can argue this, a big part of that reason was the low interest rate environment, the easy money, easy monetary policy, cheap money, which, fuels asset growth predominantly in the stock market and real estate markets. Obviously, today and for the foreseeable future, we are in a totally different environment, a totally different economy. Now, I know we've heard this, initially our government and leaders were trying to tell us that inflation was transitory, and then they said it was going to be a while, and then, it's not so transitory, and now they're predicting it's going to last for another couple of years or so. The reality is they have no idea, and the only thing you can really do is go back in history, and for a lot of reasons, I believe, I've said this on the show many times, that inflation is going to be with us, higher than average inflation, that is going to be with us for a far longer time than most people care to admit or want to admit to. And if you want to go back in history, the most recent example of us dealing with a high interest rate environment scenario was the 1970s. And if you look at the history of what happened then, in the early 1970s, about at 71 roughly, OPEC, of course, raised oil prices, which caused an energy shortage, and that fueled inflation. And we had an early 70s inflation, high inflation, and the Federal Reserve raised interest rates and all those types of things. And then what they did at that time is when the inflation started to go back down, then they started dropping the interest rates, and it would keep rearing its ugly head. Well, this went on and off roughly throughout most of the decade until finally the Federal Reserve raised rates all the way to 20% in the late 70s and finally killed inflation off. Now, folks, what I'm trying to say is this. That period of inflation was with us for a decade. If our Federal Reserve is inept today as it was then, and frankly, folks, I have no reason to expect they won't be, because they help contribute to the situation we're in right now by keeping rates far too low for far too long, and even they admit it themselves these days. Okay, when it was abundantly obvious to everybody and their brother, and anybody with some common sense, that they should have raised rates to more normal levels far sooner than they did. They were slow to react, and I have no reason to believe that they're going to act any more intelligent this time. My point is simple. I would not be surprised if we see inflation with us for the next several years, and it wouldn't be beyond the realm of possibility for a decade. I know a lot of people don't want to hear that, and frankly, I hope that is not the case. I hope they're not that inept that it's going to go that long. But we have some additional challenges today, even that we did not then. And one of those, the big ones, is the high debt. The fact we have so much debt, that is going to be a problem that's going to be extraordinarily difficult to unwind from without having slower than normal economies, inflation issues, all kinds of things. So this is going to be really extraordinarily difficult to get out of. And I don't think we're nowhere close to being out of the woods yet, even though some people want to think that. But I can tell you, gradually, slowly, more and more people are coming around to that conclusion that this is probably going to last longer than they initially thought. Now, like I said, the advantage of that is interest rate sensitive assets. In other words, everything's shifted. What used to work before will likely not work going forward, and vice versa. So what worked before was quite obvious. In general, the stock market and real estate markets, cryptocurrency, anything that had risk. Well, how should I say? I'm trying to. I just draw a blank here. It's speculative. That's the word I'm trying to think of. Speculative risk with low money, cheap money was a good bet. Okay, all those kinds of things, frankly, are going to suffer in a higher interest rate, higher inflation, and high debt environment. The things that are going to thrive, like I said, are going to be those things that are interest rate sensitive. So I'm going to share more on this as we go forward in the show. So I'm going to encourage you to stay tuned in the next segments. But we have products now that are available. This is really exciting. I've talked about 6% dividends, guaranteed, insured, tax-free for quite some time. Those are rising. We're going to see an increasing dividend rate environment for the next several years, likely 5 years plus. But there's also products, because of the higher interest rate environment, that allow us to earn double-digit returns without downside market risk. Okay, and these are our basic equity positions with IULs, with index annuities, various things like that. And these are behavioral indexes that are quite interesting because, again, they've averaged double-digit returns over the last decade and two with back testing, the whole type thing. And to give you a quick example, just to give you a quick idea how it works, and we'll get into it further in the next segment, but they'll take like the Zebra equity selection processes. They'll take the S&P 500. They evaluate them for a number of like risks, including trading frequency and things like that. They'll filter them out, and that removes over half of the most popular and overpriced equities. And then the remaining equities are equally weighted out, and it creates a more diversified and balanced opportunity for growth. So it takes a lot of the irrational exuberance, if you will, out of the picture, and it gives actually a greater potential to growth. Give you an example, the last 20 years, if you've heard of the Dalbar study, it shows that actual returns of people that have received in the last 20 years is 2.6%, according to Dalbar. The average return of the S&P 500 index without dividends is 5.2%, for example. And these equity indexes have averaged double that or better. So this is very interesting. I'm going to encourage you to contact me at toll-free 866-268-4422 or yourpersonalbank.com. Stay tuned because I'm going to get into this further and give you some options in this high interest rate environment.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And as I was stating in the first segment, I was discussing how inflation is still rearing its ugly head here and in other countries, most places around the world, and unfortunately is unlikely it's going to dissipate anytime in the foreseeable future. It might adjust to a degree, but we're going to be dealing with higher than average interest rates, higher than average inflation, quite possibly for the next several years, if not longer. And again, with this dramatic shift in this past year of our economy and interest rates and inflation and all these kinds of things, you have to think about what's going to thrive and what's going to suffer going forward. And the things that did well the last decade are most likely the things that will not do well this decade, and vice versa. So it's no question that fixed interest and interest rate sensitive assets did not do well this past decade because, think about what kind of interest rate was your bank paying, for example, this past decade. It was nothing. And now I'm talking to people who are seeing 4% savings accounts and things like that, and CDs and all that. And we haven't seen that in well over a decade, right? Bonds certainly have seen an increase in returns. Okay, your annuities and insurance dividends are already increasing and getting much higher, and are very likely to stay that way going forward. Plus, we have through index universal life and index annuities and things like that some very interesting options that have coming up strong now, because what it was is they were getting squeezed also with the low interest rate environment, but that's all opened up widely today. And to give you an example, I'll just share with you, if you're interested in growing your money with some safety, with some guarantees, but have unlimited upside potential, okay, we have those things available now again. I'm excited because I had that early in my career in the 1990s and 2000s, early 2000s. We had those things available and they were doing great. And then, of course, 0809 hit and everything changed. Well, guess what? Those things are back. And even better, because there's improvements upon these number of these index strategies, things like JP Morgan Mosaics and new NYSE Zebra Edge indexes. These are things that allow 160 to 180% participation rates with uncapped, unlimited upside, and anywhere from like a 1% fee, and some have a 0% fee. This is very, very interesting on how these strategies work. And what I mean by, say, 160 or 180% participation rate, for example, what that means is if you're invested in this index, and let's say that index got a 10% return that year, for example, then if you had a 180% participation rate, which is available today as we speak, that means your return would be 18%. And minus the 1% fee, so your return would be 17%. And on top of that, when the markets stay flat or go down, the print has a 0% floor. In other words, the downside is guaranteed. So, folks, it almost makes no sense if you start to think about it. Why invest into an asset with, if you want unlimited potential upside, you've got it. And why not? If you can protect your downside at the same time, why wouldn't you? And so we can put these in 1 year and 2 year periods that are very interesting. Like I said, actually, how we do it is usually we start 50% of the money in the 1 year and 50% in the 2 year. And then at the end of that year, we put the other half in the 2 year. So every year you have one of these come to term, so to speak. And by putting them in the 2 year, our crediting options are caps. Participation rates. I'm sorry, because they're unlimited. Unlimited cap, unlimited upside potential. Like I said, all of these options, these JP Morgan Mosaics or NYSE Zebra Edge indexes, you put it in a 2 year, you can get up to 195% participation rate, which means in the same example I shared earlier, a 10% return in that index, for example, would give you a 19.5% return that year with zero downside. Folks, if you haven't looked into one of these index strategy products, whether it be a life or annuity or one of these kinds of things, if you haven't done that recently, you need to take another look, because things in this past year, again, the economy is different. Interest rates are different. Everything is like flipped on its ear, if you know what I'm saying. What was up is now down, and what down is up. You know what I mean? And you need to adjust accordingly to that kind of thing, okay? And that's what's so important. So if you want more information on it, contact me at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422. I'm only stressing this because we still have the 6% guaranteed, dividends annual every year, steady Eddie. Those are increasing. The historical averages are around 7 to 8%, just so you know. So those are climbing. So if you want some steady Eddie, great. Get positive arbitrage and all that, we can do all that. If you want to have a portion of your funds have more upside potential and get double-digit returns without the downside, we can do that. We can also set up the positive arbitrage with those with the higher upside potential. If you understand the positive arbitrage that your personal bank offers, we can still do that type of thing. In fact, with some of these products, we have borrowing rates as low as 3.9% available today. locked in through 2023. Folks, that's interesting, okay? Because if you understand the positive arbitrage, that's something we share on this show all the time about your personal bank. Again, understand if you're earning dividends, interest, whatever that may be, interest credits, if you're earning more than you're getting charged when you access the funds, you're keeping the difference, aren't you? So if you do get, like on one of these high, we get a decent year in the markets. I understand right now it's been tough. 2022 has been tough, but there will be a point it's going to recover. Well, how would you like to be in a position where you're in an investment where it has that double-digit upside return when the markets do go up, and if they don't go up or they stay flat for a while before they go up, at least you don't lose your principal. The money you put in there is there. You don't have to ride. As I was sharing with a client actually a couple of days ago, you don't have to ride the roller coaster. You don't have to ride the hill all the way down to the bottom of the roller coaster and then come back up. Why not have a floor? In other words, whatever you start with, that's the least amount of money you'll have in your account ever, guaranteed. And then when the markets decide to take off again, which inevitably they will, there'll be a point, well, when we'll have a recovery. I don't know when that's going to be. No one knows. But when that recovery does come, you can then take advantage of that. But instead of starting from the bottom, you started from where you started from where the beginning point, right? So you're halfway up the hill already, and now you take off. Are you going to have more money in your account? Of course you will. I mean, it's kind of, you see what I'm trying to say. It's pretty exciting. I guess I'm running out of time on this segment. I'm going to have to share in the next one how the positive arbitrage can play into effect with these types of accounts that can get really interesting, particularly when you get these double-digit return years. Man, it can get interesting. Stay tuned in the next segment. I'll get into more details on that part of it. But if you want more information, contact me at toll-free 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422. And like I said, don't miss this next segment. I'm going to get into how you can borrow against it and earn interest on the money you spent. In other words, receive positive arbitrage.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. I know I'm spending more time today than I normally do on product information, but I'm doing so for a reason, with a purpose. I'm excited because we have some products that have been around for a while, but they're now becoming extremely competitive again because of the rising interest rate environment. Again, when the interest rates go up, some things win and some things suffer, right? As I said earlier, this past decade, the stock market and real estate markets did extremely well with low interest rate environment, free money, or cheap money, so to speak, easy monetary policy. Folks, all that has changed, and it doesn't look like it's going to come back to that anytime in the foreseeable future. And I'm talking about the next several years probably, if not longer. So you got to think about, well, what worked before probably isn't going to work so well in the future, is it? And that's very wise, because it's no question high interest rates negatively affect real estate, and high interest rates, high inflation that causes the stock market to suffer for the most part. Okay? Well, interest rate sensitive assets, though, thrive in that environment. So the things I'm talking about now are the types of investments and assets that are thriving. They're thriving right now. They're going to continue to do so, and more so going forward. So instead of, say, moving to cash and waiting, gosh, if you're in cash and we're at 6, 7, 8% inflation, that means you're losing 6, 7, 8% a year, aren't you? That's you're not moving forward. You're not even marking time. You're going backwards. Well, why not invest in something where either you can get steady, Eddie, consistent returns like we talk about on the show all the time, 6% dividends, insured, guaranteed, tax-free. Those are likely going higher in the future as interest rates are staying high and probably going higher. We'll see higher dividends. Historically, 7-8% is the norm. I believe it's looking likely we're definitely headed that direction with the steady Eddie, consistent, every day, every year type of investment. You can also put a portion or whatever makes sense for you into these index options where you can get solid double-digit growth on good market years. Don't lose a dime in bad years or flat years. And many of these can get you they're uncapped, unlimited upside, just like a mutual fund or a stock or anything like that, right? So you're not giving up the upside. And I've got products here that have anywhere from 0 to 1% fee, folks. So extremely competitive. But the main benefit here is eliminating the downside risk. And just so you know, with back testing and all, these types of products have averaged over 10% annual returns on many of these over the past decade or 2 decades even, okay? It is really, really impressive what these have done and what these can do. It's just, again, they fell out of favor. Not that they were bad products. They just fell out of favor over the past decade because real estate and the stock market and whatnot were doing so well. Well, that's all changed, hasn't it? So you kind of have to, it's like, they say, don't fight the Fed. Go with the flow. You got to go with what works. And so given the fact that the stock markets and real estate markets are struggling, mostly because the interest rate environment and what the Federal Reserve has done and inflation, well, go with what works. And so, we've all heard this modern monetary policy, or modern portfolio theory. My bad. My apology. Modern portfolio theory talks about typically a 60-40 split of stocks and bonds, or 50-50, 70-30, depending on your risk tolerance. Well, there's no reason it actually has to be stocks and bonds, folks. Nobody ever said it had to be that. That's just been what people have naturally, gravitated to, because that's what they've known or what's worked, certainly in the past decade, no argument. But why not go into an index strategy? Maybe your guaranteed portion or your safer portion is the steady Eddie. Maybe you put 40% there into the steady Eddie, 6% guaranteed, tax-free, every year dividends, right? And then maybe you put the other 60% or whatever makes sense for you into these index strategies with the New York NYSE Zebra Edge or JP Morgan Mosaic and an IUL or index annuity, where you can get solid double-digit returns. They're unlimited upside, just like any other investment out there, or like a stock, bond, mutual fund. Not bonds so much, but stocks or mutual funds. You got the same upside, folks, but you don't have the downside. That's the big key. And once people recognize that, it most definitely opens their eyes. I'm going to encourage you to stay tuned in the last segment. I got some more interesting stuff to share and some good news I think you're going to like. But if you want more information on any of this or have any questions, contact me at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422. Like I said, don't miss this next segment. It's going to be a good one.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. Well, I've spent some time discussing some new products that have come up. Well, they're really not new products. I shouldn't say that. They're really index strategy products that have kind of fallen out of favor. These are things that I used to work with clients on in the 90s and 2000s. And, of course, when interest rates really went to the floor after 08, 09, real estate, stock markets really shined and really thrived in those markets, no question, because interest rates were so low. It was cheap money, low, easy monetary policy, and assets like that just really, took off. Of course, that all has changed. That's why I was discussing these index products, for example, that are now really starting to shine. Again, solid double-digit growth. They got unlimited, in good market years, they got unlimited upside, folks, plain and simple, and very low fees, 0 to 1%, okay? it's worth looking into these JP Morgan Mosaic or NYSE Zebra Index strategies. Either, we got these types of strategies available in IULs and index annuities and things like that. And the last thing I'll say about that, and I'll get into some other stuff, is a lot of times people say, well, they don't want to get into an annuity or something like that, for example, because of the surrender charges, the early withdrawal penalties and things. Well, with the index annuity, into IULs, you don't really have that so much. You don't tie your money up so much. In fact, depending on how we structure these, 50 to 90% of your money is available day one, okay? So tons of liquidity also. So again, you have the unlimited upside potential, just like a stock or mutual fund would have in these index strategies. You got extremely low fees, okay? They've averaged tremendous returns, okay? And you have lots and lots of liquidity. So you've pretty much taken away, I mean, they meet everything else, and they have the one major advantage, two major advantages actually. One is tax deferral or tax-free, depending on how we structure it and which product we're talking about. So we certainly look at reducing your tax liability, okay? And two, downside protection. How would you like to set a floor in your accounts and know that your portfolio would never be worth less than this number that you started with, ever? And it will only be that number or go up from that point. So in other words, if the markets were good, you're going up. If they're bad, you don't go down. And if you have some of your money, which is what I would recommend in the steady Eddie, consistent dividend paying, the whole life policies we talk about so much, then that money grows every year. We got 6% dividends insured, guaranteed, tax-free there on that side. So in other words, using this like many people do with a portfolio, having a certain percentage, for example, in stocks and then some in bonds to get a diversification, we can accomplish the same thing, okay? But we can have the downside protection on all of it, on all of the money with similar the upside, unlimited upside. So again, it's really worth looking into. If you haven't looked into it recently, strongly recommend you take a second look. Again, if you want to do so, my number is 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422. Now, again, I apologize. Sounded like a commercial, more so product focused more than normal. But again, I think it's really important to bring that type of stuff up sometimes, at least on occasion, particularly when things are really coming about, like I said, not new, but back in favor, if you will. So, but I like to point that out just so people know. Now, I've got some other news that some of it is just plain old silly, and some of it is encouraging. One of the most encouraging things from an economic, political standpoint that's happened recently is that the House, I should say, and it was bipartisan, by the way. It was supported by 59 of the Democrats. They passed this bill that an executive order that has an annual budgetary effect of $1 billion or more would first have to be studied by the administration for its possible inflationary effects on the economy. They're hoping the idea would be it would make the current administration think twice about imposing costly new rules on the public. Now, I don't know if that's going to actually make any difference or not. But at least they're thinking and acting in the right direction, because if a bill or a law comes about or some spending plan, at least the people would have a better idea of what it's going to cost before it gets put out there, put into effect, or put into law. This is a step in the right direction for financial literacy. I've been saying on this show for years now, literally, that financial responsibility is something that has been sorely lacking, particularly in our federal government, for far too long, for decades, frankly. And this is something that needs to change. So again, it's an attitude of it's like your household budget. If you got lots of money rolling in and money's not an issue, and you want to go shopping, you want to buy this or do that or take a trip or whatever, and if you've got plenty of money and there's really no concerns about it, fine, that's great. You can go shopping, buy things, do what you want to do. But when things change, which certainly has happened in our financial position with our country's finances, in other words, you have a lot of debt, First thing you got to do is start taking a look at what things cost before you decide to spend that money. Our government has a spending problem. It's plain and simple. They're spendaholics, and that attitude, that approach, that process has got to change. Otherwise, they're going to just spend us into oblivion, and we're going to have bigger financial issues than we have today, okay? And then this next one, I like this. Elon Musk rebukes the White House over plans. They're planning to choose a new Federal Reserve vice chair with diversity in mind. And, I'm getting real. I don't know. I think a lot of people are. I'm getting, frankly, just sick and tired of hearing about this whole thing about diversity and people picking, getting jobs or getting chosen for because of what they look like. I mean, for one thing, it's racist. If you look at somebody or deal with somebody or choose somebody or interact with somebody because of the color of their skin, by definition, that is racist. Also happens to be against the law, okay? But they keep doing it repeatedly over and over again. It's not that we're color blind. I mean, you're not blind. You can see if somebody's melatonin content is lighter than or darker than yours. But it should be a non-factor. Who cares? What color somebody's skin is makes no difference, one iota, on the qualifications, their qualifications to do a specific job. And that's the part that's so infuriating. And like Elon Musk himself said, he said that the nomination decision for the next Federal Reserve Vice Chair, it affects the lives of everyone. And he added the maximum skill in monetary policy is what's extremely important in this role. In other words, it would just be so refreshing if these people who are in charge right now would use merit as a decision maker in terms of picking people for different jobs instead of what they look like. It's just plain ridiculous. And the fact that they do it, they're doing it obviously because it benefits them somehow. We need to educate folks. It ultimately comes down again to the American people, the public. We have got to say enough already. This is ridiculous. It's racist. It's illegal, and we shouldn't stand for it. And their response, it's infuriating. Okay, and I like this one thing. I'm sure most of you have heard Pete Buttigieg and this train derailment in Ohio, and it took him almost 3 weeks to show up, and it was just a fiasco in East Palestine, right? They blew up a train of bunch of chemicals, and they've got a environmental disaster on their hands, and it was caused, it was caused by decisions our government made, which were incredibly stupid by anybody. That it's just annoying as heck. And I like some of the responses. What does it take? Our transportation secretary, for example, what does it take for one of these people what do they have to do to get fired? And I agree, they're so inept, they're so ridiculous. But again, Pete Buttigieg was chosen for the job not because of his qualifications. He's never done anything in the realm of transportation. It's because of who he happens to have sex with. Who cares? I don't care who he has sex with. Why should anyone else? My question is, you're the transportation secretary. What's your qualifications for the job? Right? In fact, the fact that people put this out there that he happens to be gay or whatever, who cares? Just do your job. And if you're not qualified, find somebody who is. And the response to the White House, is they brag about their lack of whiteness. I mean, they're talking about the diversification. It's the most diverse cabinet they've ever had and all this. But from what I can see, these people are chosen, again, for who they sleep with or what they look like, not for their merits or their qualifications. So they're one of the worst cabinets in history. And I guess one of the things they got to do is that's about the only thing they have to hold on, because that's why they got the job, because of who they slept with or what they look like. It's infuriating. I just don't know what else to say. It's just plain old infuriating. And then let me give you another crazy one. So apparently the Biden administration is still proposing banning something like 50% of gas stoves with some of their new energy efficiency rules that they want to put into place. There's been a huge uproar about it. We'll see what happens again, but they're still pursuing this crazy idea. And meanwhile, you have China, for example, going full steam ahead with new coal plants as the West is trying to go green. China, in fact, over the last year has approved the equivalent of about 2 coal plants per week. They're just putting in coal plants left and right. You know, we could have our emissions go to 0 as a country. U.S. could do that. Europe could do that. But if China keeps doing what they're doing, it's not going to make any difference, okay? It's just plain and simple. But, you know, common sense has never been very common, right? Especially these days. And then you get some of these things that are infuriating beyond belief. Like, I had to look twice at this one. The current L.A. mayor, the mayor of Los Angeles, wants to lower standards to help diversify the LAPD. Wow, that sounds like a great idea. Let's lower standards for the police. That's just going to work. Who's that going to work out for? The only people I can think of that will benefit will be the criminals. Hey, guess what? The the drug cartels, they'll love that, right? So you got to ask yourself the question, why would the LA mayor want to do that? What benefit would it be to her or to her citizens? Then you have to question, what's her motivation? Who's supporting her? Who's behind this, right? I mean, is it the drug cartels? They certainly have a lot of money. I don't know. I don't have the facts. I don't know. But you have to ask the question. Again, if you want to understand something, follow the money. Let me give you another one. Seattle School District is forced to do layoffs amid plummeting student enrollments. You know what? This one actually is a positive because, in fact, they're saying they're having so many students leave their school district because they're ridiculously bad and the stuff that they're not teaching, right? And turns out homeschooling is doubled. It's doubled in Washington State. That's a positive. Good for them. Guess what? They maybe they should wake up and realize, hey, you're doing no good for anyone. Eventually they'll put themselves out of job. I have no problem with that. So it's these kinds of things that just continue to move forward and are infuriating, yet at the same time we see people still standing up and fighting and haven't given up on this country yet. I'm one of those. I think, where else are you going to go? And 2, I think this country's still worth fighting for, and certainly the people in this country are worth fighting for. So I haven't given up in this country. I believe we're going to turn this around. We just got to keep fighting and keep pushing back on this ridiculousness. In the meantime, if you want to learn how to navigate this craziness, contact me at 866-268-4422 or yourpersonalbank.com. And as long as it's on our money, I'll say this, in God we trust.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.